Good morning, sir. My name is Julia Gede Savitri. I'm from Accounting D. This is my video record about the videos I watch. What is an income statement? An income statement is one of the three important financial statements used for reporting a company's financial performance over a specific accounting period, with the other two case statements being the balance sheet and the statement of cash flows. Also known as the profit and loss statement or the statement of revenue and expense. The income statement primarily focuses on the company's revenues and expense during a particular period. The income statement focuses on the four key items: revenue, expense, gains, and losses. It does not cover receipt money received by the business, or the cash payment or disbursement money paid by the business. It starts with the details of sales and then work down to compute the net income and eventually the earning per share (EPS). Essentially, it gives an account of how the net revenue realized by the company gets transformed into net earning, a profit or loss. Revenue and gains. The following are covered in the income statement, so its format may vary depending upon the local regulatory requirements, the diversified scope of the business, and the associated operating activities. Operating revenue. Revenue released through primary activities is often referred to as operating revenue. Is a company manufacturing a product or of a wholesaler, distributor, or retailer involved in the business or of selling that product. The revenue from primary activities refers to revenue aside from the sale of the product. Similarly, for a company of these franchises, if the business of offering service, revenue from primary activities refers to the revenue of fees earned in exchange of offering those service. Non-operating revenue. Revenue released through secondary non-core business activities are often referred to a non-operating recurring revenues. These revenues are sourced from the earnings which are outside of the purchase and sale of goods and services and may include perform income from interest earned and business capital lying in the bank, rental income from business property, income from strategic partnership like royalty payment receipt, or income from an advertisement display placed on the business property. Gains, also called other income. Gains indicate net the money made from other activities like the sale of long-term assets. This included the net income realized from one-time non-business activities like a company selling its old transportation fund, used land, or a subsidiary company. Revenue should not be confused with receipt. Revenue is usually accounted for in the period when sales are made or services are delivered. Receipts are the cash received and accounted for when the money is actually received. For instance, a customer may take goods or service from a company on 28 September, which will lead to the revenue being accounted for the month of September. Owing to his good reputation, the customer might be given a 30-day payment window. It will give him time till 28 October to make two payments, which is when the receipts are accounted for. Expense and loss. The cost for a business to continue operation and turn a profit is known as an expense. Some of these expenses may be written off a tax return if they met in IRS guidelines. Primary activities expense. All expense incurred for earning the normal operating revenue linked the primary activity of the business. They included the cost of goods sold, selling, general and administrative expense, depreciation or amortization, and research and development expense. Typical items that make up the list are employee wages, sales commissions, and expense for utilities like electricity and transportation. Secondary activities expense. All expense linked to non-core business activities, like interest paid on loan money. Losses as expense. All expense that go towards a loss-making sales or long-term assets, one-time or any others unusual cost or expense towards lawsuit. While primary revenue and expense are insight into how well the company's core business is performing, the secondary revenue and expense account for the company's involvement and its expertise in managing in the ad hoc non-core activities, compared to the income from the sale of manufactured goods. A substantially high interest income from money lying in the bank indicates that the business may not be utilizing the available cash to its full potential by expanding the production capacity, or it is facing challenge in increasing its market share amid competition. Recurring rental income generated by hosting billboards at the company factory stretched along a highway indicates that the management is capitalizing upon the available resource and asset for additional profitability. Okay, sir, thank you.